Hi, welcome to our live webinar. Today we're looking at like 8 things, tax saving things, tax saving reasons to go expat this tax year. We're looking at the start of the new tax year in April, the new UK tax year. Some of these ideas you can use in the UK for tax saving. Others, you can make additional tax savings by going expat or mix and match. So join us each week, Living and Working Abroad, for our live webinar to find out more about saving money and tax as an expat. Good morning to our regular viewers. Welcome here. So 8 tax saving reasons to go expat this year. Now these can be tax savings in the UK as well, but also generally for expats. Ways to save tax money as tax savings as an expat include relocation to change your tax residency, or to change the tax residency of your business or family trust. You can make wills and make gifts to avoid inheritance and capital gains taxes. So all these things are tools that we've got to help expats living and working abroad with a UK tax base or connection to save tax in the year ahead. And what a year. There's big increases in UK taxation, so there's big opportunities. I'm going to look at 8 different ways that you can angle to save tax in the year ahead of following the big changes in the UK budgets. First of all, let's look at capital gains. Many people don't consider this, but it's a real factor. Capital gains is charged on crypto gains, stock share gains, other valuable assets, as well as business and property sales. And the allowances on capital gains is going down. So up until last year, the last tax year ending 5th of April 23, in the UK, you could get 12,000 a year as an additional capital gains allowance. And that's been reduced to 6,000 this year, and then it's going down to 3. So the additional personal allowance for capital gains has been reduced massively, and therefore it's becoming, that will extend the reach of the tax, and possibly mean an extra £5,000 of capital gains tax that could have to be paid in the UK. So if you've got crypto sales, they are capital gains sales. If you're selling a business or you're selling shares, they are capital gains sales in the UK. If you're selling property, actually the capital gains rate is not 10 or 20%, but it's 18 or 28%. And residential property capital gains in the UK is fixed to the UK. So expats investing in UK property cannot avoid that capital gains if they buy personal residential property directly. You'd have to consider using a company structure where the capital gains falls under corporation tax, where you can make tax savings there. So for more information and guidance, contact us at projectpartnership.com. But consider, if you go expat, then capital gains could be as low as nil. So if you had a tax residence in Cyprus, for example, there's only capital gains on Cyprus real estate. So any Cyprus property has got potential capital gains at 20%, but there are no capital gains tax on savings or crypto. So it can become a very good business and investment base for expats living and working abroad. For more information and guidance on getting a Cyprus tax residency, you can contact us at projectpartnership.com. There are other options within the UK. There's a business relief system and that they can get, but you have to be registered for that effectively for a couple of years to get your relief, and then you have to make the application for that capital gains relief. If you've got a business to sell and you become non-resident expat before you leave the UK, that property, not that property, that business asset or that investment asset that you sell after you've left the UK can be free of UK capital gains tax at 20%. There's many countries around the world that won't charge you for that capital gain. So by going expat, changing your tax residence before you consider disposing of business, investment, or crypto assets, you can make considerable tax savings. So you can pay as little as 0% capital gains tax. For more information and guidance, contact us at proactpartnership.com. So the next tax that's being charged and where there's tax savings opportunities in the UK are for dividend taxes. And dividend taxes, there's a number of different ways to look at that. And so first of all, we're just going to look at what that means to you in the UK. So dividend taxes ostensibly are charged at 8.75%, but that's only if you're a basic rate taxpayer. When you add up all your incomes, all your income sources, including your earnings and your dividends together, do you come under the basic or higher rate or additional tax rates? So if your total income is above 125,000, so you're into additional tax rate, or above 50,000, a higher tax rate. So there's a higher tax rate on dividends that can apply. So basically, a dividend in the UK is taxed at 8.75%, and then it goes up to nearly 34%, and then nearly 40%. So 8, 33, 39 and bits is the dividend tax you could pay. It depends on how much your income is. There used to be additional personal allowances for dividends, but they've been reduced as well. So if you are getting a higher income or even a smaller income, those personal allowances are being reduced. So an extra £2,000 of personal allowance for dividend income from investment portfolio is now being taxed as well at 8.75%. But if you're operating a personal service company, your own business, and you're getting dividends and you're to the high rate tax band, then you're quickly going to be paying as much as a high rate taxpayer in any case. So there's big savings that can be made there. When you look at the role of an expat abroad, you could have a tax on a remittance basis, but also there's countries that won't tax you on dividends from overseas. So again, Cyprus has a non-dom status for expats that could work for remote workers, or it could work for personal service company, people operating a personal service company, or nomad workers, where you can pay 0% tax on dividends. 0% tax on dividends. So you could take your personal allowance in the UK, 12,000, no UK tax, and a dividend as a remote worker based in Cyprus of 100,000 and pay 0 tax. For more information and guidance on tax planning using dividends and a personal service company for remote working abroad, contact us at proactpartnership.com. The next area I want to look at is IR35, because it's linked to the dividend taxes. So IR35 is only applicable in the UK. It's a UK tax law, and it's designed to stop people working remotely or not properly self-employed. So it doesn't want to consider people as contract workers. If they're contract workers, it wants to tax them as employees. And that's essentially what IR35 does. It doesn't let somebody who's working as a contractor just for one company on one contract enjoy the benefits of being self-employed or operating through a personal service company. So instead of paying a class 2 and class 4 national insurance at up to 10%, you could be paying a full employee-employer rate and it can become quite onerous. IL35 is applied by large companies, so that their turnover has to be over 10 million, or the balance sheet over 5 million, or more than 50 employees for it to apply. So if you've got a small UK personal service company, or your contractor is a small company, IL35 rules can be avoided. It depends who you're dealing with and how you're dealing with them. But if you're a remote worker and you're not based in the UK, a UK company does not have to apply IR35 to you. So again, with the previous scenario with dividends, we looked at that. We said a remote worker could operate as a personal service company, or as a sole trader abroad, and not be subject to IR35 rules. If they're operating through their own personal service company, they can then enjoy 0% dividends on their income. For more information and guidance on going expat, to remove yourself and your business, your small business, from IL35 rules, contact us at privatepartnership.com. So the next area to look at is inheritance tax. It's a bit of a jump from talking about income and business, but it's just as valid. If you've built up a business, you've got some assets, those assets can be disposed of at some time. If you've got savings, or business to sell, or investments in hand, or property, they're all subject to inheritance tax when you die. In the UK, inheritance tax is charged at 40%. So if you do nothing when you die, you've got a personal allowances which you can manage, and potentially save up to £1 million if you've got a main family home in the UK on death. But by gifting the property during your lifetime, you could increase the allowance by an additional 150,000, because you can get main home relief of 500,000 on a family home if it's gifted within the family while you're alive, not when you're dead. So it's being proactive to take that investment decision before you die. If you leave it in a will, it becomes subject to inheritance tax assessments. A married couple have personal allowances that they can share between them, and so the inheritance tax might only apply on second death, but it doesn't go away. You can gift after first death, but if you gift before first death, you can make arrangements for that. For example, if you gift into a trust, a family trust, that trust could pay no tax while holding that asset. Free yourself up after 7 years from an inheritance tax liability on that business or that investment asset, and be free of any other taxes within that trust, as long as it passes down to your beneficiaries when the time comes. There are taxes on UK trusts if you're trying to use those to plan to avoid inheritance tax, but they're not as much as the inheritance tax at 40%. So you're giving yourself that option to move the money away into other resources. And there are trusts around the world, for example, a Cyprus International Trust, where there are no taxes on any income or gains or dividends from outside Cyprus. So you can have an offshore trust, an offshore family trust, to manage your assets and protect yourself from inheritance tax in the UK. But the gifting rules mean that it's a long-term strategy on that gifting. So to make those changes and make those movements, this is how Pirate can help you plan ahead in the years to protect your family home and business from those assets. For more information and guidance, contact us at privatepartnership.com. The next area I want to look at is to go back to pension taxes. Now, pensions are a big fanfare in that the lifetime allowance caps were removed. This was an additional tax that was being charged on pension funds, but the allowance was changed in theory to encourage people to continue working and continue contributing into a pension fund. But the point is that the tax saving opportunity still remains, and it still remains the same. So constraints on how much you can put into a private pension plan each year, up to 60,000 or 100% of your earnings. But you can maximise that, then you can reduce down your income tax allowances. Those allowances still exist if you're operating a personal service company while you're abroad. So if you've got a corporation tax liability that's coming up, gifting from your personal service company can create an expense that could reduce the capital gains tax. More on that later. So if you've got if you're living and working abroad, and you're considering working through a personal service company, there are still, you can use pension planning in the UK to save you some tax. And if you're in the UK, you can do that as well, and possibly look at increasing your contribution to reduce the amount of tax you make, for reasons that we'll find out next. Otherwise, contact us at productpartnership.com for more information and guidance. I want to look now at personal allowances. Now, the personal allowances are quite radical changes in the new tax year, and it opens up the opportunities. Now, if your earnings are over 125,000, you're into the additional tax rate. So the highest tax rate in the UK is 45%, and it's a realistic objective for a lot of people to earn once your earnings are over £125,000. And don't forget, if your earnings go above 100,000, you're losing your personal allowance. So there's opportunities there. If you're taking all salary from your personal service company in the UK, then you're going to lose your personal allowance, which at 40% is going to add about 5,000 to your tax bill straight away. But then at 125,000, you're into 45% tax as well. So the tax rates are going up rapidly. So if you've got the opportunity to work remotely and be a tax resident in another jurisdiction, you can limit those top rates of taxes. Now, some countries still have higher rates of tax than that, or comparable rates of that. But there are other countries where you can enjoy tax savings by becoming a tax resident and relocating overseas. Remembering always that when you relocate, you have to take up a permanent residency in that new country to become a tax resident there. So the personal allowances in the UK are frozen as well. So the 12,570 personal allowance, that's a frozen rate for this year and for subsequent years, without tax. And then beyond that, you've got 20% tax above 50,000. Using round figures, you've got 40% tax before you get to 45% at 125,000. And don't forget the additional personal allowances you could potentially get with dividends and savings. They're going down as well. So that there's less relief all round on the personal allowances as you squeeze people into paying a bit more tax, even though the tax rates haven't gone up. By organising the way you work, if you're using a personal service company, if you're working remotely overseas, if you're using a dividend strategy as an overseas remote worker, these are ways that you could save tax and maximise your personal allowances, but also save additional tax by paying your earnings in a different way as a tax resident of a different jurisdiction. You need to relocate, you need to have a permanent home, and then you don't necessarily need to work from that location, but you need to have a permanent home and a tax residency. You could still be nomad, but even a nomad needs a tax residency. So if you're a UK resident, tax resident, you remain UK tax resident until you relocate abroad. Once you've done that, you can enjoy the tax benefits of that jurisdiction. You may move for family reasons, in which case tax saving is not preeminent. If you're moving for tax reasons, consider which is the best tax jurisdiction for you. And for more information and guidance, contact us at productpartnership.com. Next, I want to look at income tax. Obviously, now we've been covering that in a number of different ways as we've been going through that. But we're on number 7 now, which is for income tax. So in the UK, the income tax rates aren't going up, but the tax bands have changed quite radically. So the starting rate for 45% tax is now only 125. That's down by £25,000. 40% tax is still paid at the same rate as well. So any total earnings over 50,000, you're now paying 40% tax in the UK. So there's a real possibility of increasing tax in the years ahead for UK residents. If you've got the option to relocate and work remotely using a personal service company or as a sole trader, then you can potentially reduce those taxes right down. So again, looking at a country like Cyprus, you've got a maximum income tax rate of 35%, but they also have rules where as a non-dom, you could pay tax on a remittance basis, i.e. your contract working abroad, you're not paying tax in Cyprus. But you've also got a system where if you're operating a personal service company, you pay 0% tax on dividends as well. So there's big income tax savings that can be earned by working in a jurisdiction where there's either no remittance tax or a lower rate of income tax or special schemes like 0% tax on dividends that are available for relocating UK expats that are living or working abroad. For more information and guidance, contact us at productpartnership.com. The other big noise, the big tax change in the UK. The other big tax change in the UK is corporation tax. So our 8th tax saving opportunity is with corporation tax. The headline rate has gone up from 19 to 25%. Now the UK will claim that that's still the lowest rate in the G7. That's the big economies around the world. But there used to be the lowest rate in the G20. So there are many other countries now, stable, large economies with lower tax rates. For very small companies, the corporation tax rate remains at 19%. So let's be clear about this. If your net profit is below £50,000, then you can still pay 19%. And then it's graduated up to 25%, up to 250,000. So if your net profit is over 250,000, then yes, you will pay 25%, and good for you. But if you remain at a small service company with a net profit below 50,000, then you can pay still 90% as a flat rate corporation tax. And paying flat rate corporation tax is obviously better at 19%, is better than paying corporation tax at 45%. Did I say that the right way around? Paying flat rate corporation tax at 19 or 25% is better than paying income tax at 45%. So there's still advantages to using a personal service company if that business model works for you in the UK. You pay a lower tax rate that won't go up. If your net income is below 50,000, whether you're an individual or a company, you're still going to be paying that 20%, that 19-20% tax. However, if you're operating through a personal service company, you can expense. So if you've got business expenses and contractors, then that you can put those through the company, and that enable you as a sole trader or as a company that can keep the expenses down. And keep the net profits down by increasing the expenses. So the opportunity there is that the personal service company, if it's fully expensed, then it could potentially maintain a lower flat rate corporation tax. But if you then distribute those retained profits, you've then still got a dividend liability in the UK. So even though you protected your corporation tax income to 19% or 25, you still potentially got up to 39.35% as a dividend tax. And so one way or another, the corporation tax is going to catch you out in the UK, either through the dividend taxes or through the income taxes. By working remotely, using your UK personal service company, you could receive income as a tax resident of the right jurisdiction at a lower rate. So, as we said previously, if you're working from a personal service company in the UK as a remote worker and you're a Cyprus tax resident, then you could enjoy 0% dividends. So you get a flat rate corporation tax rate of 19% and receive dividends with no additional tax. You would need to become if you're working in another jurisdiction, you may need to become tax resident there. So you could do that as a contractor, sole trader, or you could do it as setting up a branch and operating there. And that would enable you to potentially reduce the profits slightly more to draw the income. So you can maximise your personal allowances in the UK as well as overseas by using the contracting power of a personal service company. When you've got different tax residencies for your company and for you as individuals, and maximising that within your family group as well as your team that you're working with. But in addition to that, there are other jurisdictions where they have different corporation tax rates. That may be as low as 0 in the Middle East, or it could be 12.5% in Cyprus. So although the global tax rate for corporations is going up to a minimum of 15%, that actually only applies to high turnover companies. So for smaller businesses, that doesn't necessarily apply. And Cyprus are maintaining in 2023 a 12.5% corporation tax. So you have to distribute your profits in Cyprus, but the way you distribute them can avoid taxes as well. So it can become very tax efficient. So the different ways of running your business remotely using an offshore company could reduce your corporation tax rate to half of what the new UK corporation tax rate is going to be for your business. So, in summary, there's tax saving opportunities in the UK that you can take on capital gains, on dividends, on personal allowances, on pensions, on income tax rates and corporation tax rates, as well as finding ways to reduce your exposure to IR35 rules, which are just for the UK. That means you could pay a lower rate of overall tax on your portfolio of income, whether that's from property, business, or investments. As an expat living and working abroad, so you could be working remotely, and although you may want to move around, you would still have your one jurisdiction where you're tax resident. So move that away from the UK, and that new tax resident can enable you to enjoy a minimum amount of tax. There may be gifts that you can make to avoid capital or inheritance taxes, save up to 40% there as well. But as an expat, you need to consider making a will, possibly gifting and creating a family trust to protect those assets across border and across generations. For more information on gifting, making a will, expats and creative family trusts, contact us at proactpartnership.com. Remember, we said in Cyprus, a family trust set up for expats on an international basis will have no local taxes at all on worldwide dividends and income. To go expat, you do need to relocate. You need a residence abroad. It doesn't stop you traveling around. The residency restrictions and short stay rules still apply in countries where you won't have a resident permit, but you can have a resident permit in as many countries as you like. And if you've got a resident permit, you can also get a tax residence to enable you to save money and tax abroad. For more information and guidance on relocating abroad, you can watch our YouTube channel, subscribe to that, and find out more about how you could enjoy an adventure around the world as a remote worker or a nomad worker, or just retiring in a location where you've got a different tax on your overseas, on your UK property, investment, and business assets. Thanks very much for listening. And join us next week, when we'll continue to look at residency and tax savings abroad. And don't forget to share the link for our blog with your friends and family. Thanks very much for listening. We'll see you next time.